Team, hello, how are we doing? I know it's been a long time. I do apologize for not being live for quite a long time. It's been very busy. I'll explain why in a sec. But before I do, in this video, first live for a while, I want to ask the question, where are interest rates going? Because here's the thing. When I started this channel last year, much of the narrative was about the property market going into meltdown. Will it, won't it? What are, the various permutations of that equation? Now, I feel the risk of that has subsided considerably. We've been talking about it for a few months, really since Christmas, or since just before Christmas, about what could be going. And now the big question, the big thing that's on everybody's lips, on everybody's minds is, what's going to happen to interest rates? When will they come down, right? And could they even go up before they go down? So today, what I want to do to kind of reintroduce back into YouTube sphere is do an overview of everything that's going on macroeconomically in the housing market and the economy, and have a look at that question about interest rates. Where are they going to go? Are we going to see mortgage rates go back up? Are we seeing swap rates go back up? Or are we actually going to get ahead of the pack? And is the Bank of England going to be the first people globally is going to pull the trigger and start the rate down? Most importantly, how far are they going to go down? Because that's going to be of such interest to anybody who is in property investment or property development or looking to buy their own home. It's going to set the state or set the equation for the next, I would say, 5, 10, 15 years of the property market. Where do interest rates settle? I've always said it. It's not about where do they peak. It's where do they settle. So let's go into that. So very good evening, everybody. Brody, hello. I can see lots of comments in. As always, team, what we are going to do is I'm going to go through the content. Please put comments in if you're on the live. If you're watching this on the replay, again, comment on the video. I'll always get back to you. If you're new to the channel, which a lot of people might be because I've not been live for a while, on these lives, I look at objectively the data to try and read in between the lines and work out what's actually going on rather than all the mainstream media headlines and YouTube sphere headlines and all the doom mongering and all that sort of stuff, so we can make more informed decisions. And please, if you're looking to invest in property this year or next year, or buy a new house this year or next year, and you want to understand what's going on in the market on a macroeconomic level and help or understand when is the time, what price should we be buying at, and what's going to happen in the next few years, please subscribe to the channel as you'll get lots of great content from me breaking down objectively all of this data. And as you subscribe, it's going to get more reach to more people who need to see this rather than getting sucked in to the normal sensationalist headlines that we see going on. So with that as an intro, let's get into it. So what I want to do, right, is I want to dive straight into, that's one I want to see at the end. In fact, before we go into this, I want to explain a little bit why I've not been live very much, I'd say, for the last couple of months. Last year, I was doing 1 or 2 every week. As we went through Christmas and into January, I was still doing 1 or 2 every week. And then the world has gone manic. Okay, I am a property entrepreneur first and a multiple business entrepreneur, YouTube second, right? As and when I have time, I'm not a YouTuber. The last 2 months have been the busiest 2 months in my businesses, I would say, for at least 18, if not 24 months, okay? And that's because I'm seeing an awful lot of opportunity as what appears to be the world waking up again. So when I look at the property business, we're just finishing off a refurb. We've got a couple of units we just put on Airbnb as short-term lets. We've got 3 properties in legals going through, or 3 sites in legals going through to be purchased, and more offers that are going on at the moment. Very exciting offers. Interesting opportunities with high yielding, high cash flowing properties as we see, or I believe we're at a accumulation phase and when I talk about property, for those of you who haven't seen me before, I'm talking about high cash flowing commercial grade property. And when I say commercial grade, anything that has a commercial valuation on it. Next week, I'm going to do a live where we're going to talk through the opportunity and how this could be the perfect time to be entering this market. I'm not necessarily talking about residential, which I think is lagging behind and I don't believe has actually bottomed yet, despite some of the things we're going to look at. So very busy in the property world. The scaffolding business has come back to life, and we're on a lot of new build sites at the moment. As we've seen, sort of fairly, I would say, medium size house builders breaking ground beginning of this year as they look to build into what I believe they hope will be interest rate cuts at the end of this year into next year and get people buying again. So we're very busy in the scaffold business, having to do a sort of bit of work finance wise to get more kit to service the sites. and also extremely busy in the coaching business. So if I just show you, this is my May coaching program within the Property Unicorn Club. You can see you've got coaching events almost every day as we go into May in some capacity with some one of my groups or another of the groups of clients that I help people buy high cash flowing property in various mechanisms. So everything is coming back to life. What I want to do is go through just a snapshot, the HPIs, okay, to see where the indices reckon we are. We're coming to the end of April, so some of these are a little bit out of date now. Here's the nationwide, where we can see the rate of change is increasing. The rate of change of property prices is on the increase in terms of trend. This graph has got both southern and northern England, the red line being northern, with north actually in an annual house price growth, right, year by year, positive, south still negative. So we are seeing that big divide still between the north and south. However, the trend is clear for both, according to the HPIs. I do not want to go today into the validity of the HPIs. I caveat everything that these HPIs are massively skewed because of a lack of liquidity within the data set, with the amount of transactions going on, but trends are what we want to see, okay? I'm looking for the trends, not the absolutes, and the trend is reversal, I would suggest, according to the HPIs. If we go into the Halifax, and again, let me just zoom in on the last Halifax one. I want to look at the actual nominal house prices for the Halifax. We have seen a dip, right, in Halifax after what was quite a long run up in terms of nominal house prices. Not unusual to see a dip. Nothing goes up or down in a straight line. That's not a trend. I would say the trend still is broken out of the downtrend, and we'll see what goes on with this. We'll talk about why there's been a dip. But when we compare effectively the two, the nationwide and the Halifax, we have seen a bit of a divergence over the last couple of months, with the Halifax showing more positive. The nationwide showing more positive, the Halifax showing a little blip. I believe this just shows where we are in the market, which is a lot of uncertainty, very low transaction data, and we because of the way the models work, it's very easy to see skews in either one. So they're not in lockstep with each other, but it's certainly difficult to say that we're in massive market meltdown. Okay, if we move on to UK ONS, this is just the actual figures. Okay. It's difficult to zoom in on this because if I do on the way this graph works, or the way the website works, it's just going to compress the time period, and I just want to see this longer time period where we can see we've had a dip down, okay, but then it's kind of going up a little bit more, but this is way laggy, right? These figures are best part of 6 to 9 months out of date, so I don't take too much looking at this in the rearview mirror, because things could be completely different. We could be all the way down here now. We could be further up. Again, trend wise, we bottomed and seen a peak up. I would expect this to come down again because of the lag when you compare it to the other HPIs. So I don't take too much from that. If we go to Rightmove, okay, if we look at the Rightmove asking prices, they are definitely spiking up again. Now again, just to clarify, Rightmove is not a hedonic regression model. Rightmove is the average listing price that goes on. So it doesn't take into consideration all of the properties that are then being cut in price. But you can see the average listing price is going up. Again, the argument could well be more expensive houses coming on. But again, it could be more confidence coming into the market and people listing the houses on average more expensive. So we can see that is now a distinct trend on the Rightmove. After where it looked like it was starting to capitulate at the end of 2023, we've seen, without a doubt, a resurgence of optimism in listing price this year. Now, if we look at the average stock per agent, I think this is, for me, these are the more interesting ones, right? So we've actually got some more stock coming onto the market. Okay, if you look at sort of Q3 last year, we had a trend going up with stock. I believe because it wasn't selling more than the fact that more people were listing, so stock wasn't selling. This stock then started to come down, okay, and it's now started to go up. I believe the stock is now starting to go up again because more people are listing their properties. More confidence, more optimism, people are listing. Also, more people coming off the cheap fixed rate debt, okay, as we come into, really the final year of a lot of people who fixed in sort of 2020, 2021, 2022 on 2-year fixes. All of those are coming to an end this year. It's going to be the end of the cycle. The 5-year fixes, with people who are fixing in, post-COVID at 5 years, we've got quite a long time until those start coming off. So that, anyway, we're kind of getting out the 2-year fixes. So we're still seeing a lot of people come off cheap fixed rate debt, and I would hypothesize that that's hurting people in more expensive properties down south. So more people are listing, having to sell up. Now, this is very interesting, right? Is the average time to secure a buyer? Because after we saw a very long uptick, a very long uptrend in time to sell a house, it's now quite markedly, I'd say, coming down, which implies there are more buyers out there. Okay, so everything looking like there's more activity going on with Rightmove. Let's just do the Zoopla first. Okay, with Zoopla, we are very obviously seeing the split north-south in terms of Midlands and up. We're seeing Zoopla thinking property prices are going up, south or London and south going down. Again, no massive surprise there. What I do want to focus on is this one, which is flow of new supply and stock of homes for sale. So we are seeing some more sales agreed, okay, but we're seeing more flow of new supply and a bigger increase in stock for sale. Now, these figures are year on year to the beginning of 2023. Now, don't forget, beginning of 2023 was way low liquidity. So I would want to see this compared to a 5-year market trend rather than compared to 2023. But if we go year on year, we are seeing more stock for sale. So what to me is very obvious is we are thawing, right? We are seeing an increase of supply, and logic would dictate, okay, that in the current market where we've still got high interest rates, we've still got affordability issues, an increase in the flow of supply for residential property will probably actually put a downward pressure on house prices, increase supply, unless there's suddenly loads of demand from somewhere, which I'm not quite sure, there is for the affordability. I would suspect, right, regardless of what the indices say, that the rest of 2024, we're going to see some downward pressure until those interest rates really start to come down, if they do. So that's kind of my thoughts on residential. Might be completely wrong. We might be going back into boom cycle. I don't see it as we go into some of these other metrics we'll look at. So let's have a little look at the latest RICS market survey. Right, RICS is starting to look quite a lot more. So let me just scroll up to the top here. Quite a lot more bullish, actually. If we look at price expectations, effectively, if you haven't seen the RICS before, the way that these charts work is, if we're plotting something as a negative, it means more agents who are surveyed than not see it as a negative, that things are going to go down, right? Again, if it's positive, more agents than not think things are going to go up. So if it's all the way up at 100, it means every single agent thinks we're going to see rising market. If we see 50 think it's rising, 50 think it's falling, it's going to be a 0. Now, the purple line is the next 3 months. So nothing particularly interesting on price expectation is happening. But when you look at the next 12 months, okay, we're now seeing a big old spike into the positive, which means, and I probably agree with this, that 2024, everybody thinks stagnation, or it feels like we're going to be in stagnation, if not slightly depressed. Then as the interest rates start coming down, the expectation is it's going to take the shackles off a little bit and the housing market might start to rebound. But we're going to need to see those interest rates come down, which is what we want to talk about in a bit. So that's price expectation. Again, if we look at sales expectation, I just want to zoom in a little bit more to make sure you can see that. Again, we are in positive in the next 3 months, but the next 12 months, we see a big spike up in the next 12 months. Sales market charts, okay, average sales per surveyor, we have seen, a bit of a spike up. It's kind of flattened off a little bit. Average stock per surveyor, again, we're seeing a trend up in average amount of stock per surveyor. We're still and it's really important to caveat this, we're still well below, long-term averages here, which is why when I looked at the Zoopla one, I think it's important to caveat that these figures, even though it shows, 20%, 11% flow of new supply, 20% stock of homes for sale, it's comparing it to this time last year. So we're still talking really constrained market, but the trend's going in the positive direction, okay? Let's see what else we've got. Lettings. So we're actually seeing tenant demand start to drop off. So have we seen the peak of that boom in rental increases? Certainly in one of my areas, Chester, I've been keeping an eye on it. I'm seeing a lot lot more rental stock sticking on the market, okay, and a lot of price reductions in rentals. Not the same down south. So I spend half my time in Winchester, half my time in Chester. Down south, very, very strong rentals market, very little stock. Up north, a lot more coming on. I would say downward pressure, or not downward pressure, but well, potentially downward pressure on lettings, on rental. And we're still seeing a negative in terms of landlord instructions, okay? So this is where we are. So it looks like we've come over the peak of the rents. So that's where we are with the RICS. And then the final bit of final couple of bits of positive, when we come out of the housing market and start to look at the economy, when we look at the PMI, again, we're seeing increases in the PMI. Now, for those of you who don't know what the PMI is, it's the Purchase Managers Index, which is a survey of purchase managers. And again, if the figure is above 50, there is a general consensus that things are getting better. Let's just keep it in layman's terms. If it's below 50, it's like, red flag. We have seen we were below 50 from sort of summer, that August last year, which is when people were starting to panic a little bit, I would say. When we're thinking about last summer, if you remember, swap rates were going up, mortgage rates were going up. People were going, right, are we going to see 6%, 7% Bank of England base rate? PMI was down, sub 50. And I don't remember, I did a live where there was a potential leak to the Bank of England, or the Bank of England potentially heard that the PMI was diving, I think it was going to be in September, to about 46, which is why there's a lot of red flags going on. But it's recovered a lot, and we're now firmly in plus 50, and in April we've ticked up to 54. So that's positive. And of course GDP, we've now had two months worth of positive growth. So, technical recession, Q4 2023. Are we out of it already? Very, very mild technical recession. Looking at this, construction is still down, which again is interesting in itself. So when you look at all of these figures, I'll be interested to see what you're talking about in the comments in a second. When you look at all of these figures, everything has a positive slant to it, a positive skew to it. Increasing confidence, and a lot of confidence is drawn from perception in the housing market, right, and the economy. And I saw an article that consumer confidence is at the highest it's been really since the start of the cost of living crisis, and inflation going up. So that all is showing, right, that people are expecting better times ahead. Now, how will this play out, though, into what happens with interest rates? So what we have seen, let's go back over to the graphs, right? If we come over to the swap rates, and I've not looked at the swap rates for a while, but we are 5-year fix is always my benchmark to look at. Let's just look at that. And we're still, at the moment, above 4% swap rate. Now, not a huge amount, which means we've kind of been flirting in that range, you can see a month ago, 3.8. Actually, a year ago, 3.9. So we're kind of, where we were last year. Swap rate's sitting around about that 4%. Not changed an awful lot. So it's not like they're spiking either way. There's obviously nervousness about inflation sticking. The data over from the States is showing that sort of more baked in services inflation, strong labor market, and of course geopolitical tensions, Middle East, are causing concerns about, are the interest rates going to stay higher for longer? Okay, and that's very much feeding into mortgage rates. Again, we can see we're seeing some tick ups at the moment. And if I go and have a look at some news articles, this is one from a couple of days ago, where we're seeing some mortgage lenders hike up their interest rates as well. Now, what does all this do? Of course, by swap rates staying high, mortgage rates staying higher for longer, it was a really good time. If anybody was fixing in mortgages, sort of January this year, there were some really good deals about. I'm just looking at this graph now. Actually, we had 5-year fixes at, what's that, 5 point for a 95% loan to value mortgage. Let's just go 85. So there we go, 60% loan to value, 5-year fixed rate in January. You could get one for 4.15%. I mean, still now it's 4.36, which is obviously a little bit high, but we are seeing those interest rates creep up again. Now, what does that do? Of course, it adds to the affordability equation. Okay, so house prices are directly linked to the interest rates. Okay, it is one of the major factors that dictates what we can afford to borrow. Interest rates go up, we can borrow less for the same amount of monthly repayments, which of course puts a ceiling on house prices. So the sort of little surge we've had in the first quarter is that now going to be tempered? And are we going to go into stagnation? Are we going to go into, sort of modest nominal price falls over the next, 3-6 months? I personally believe we are. All the talk is about inflation coming down, but again, let's look at this dark blue line here, which is owner-occupier housing costs, which continues to rise. Okay, when you look at the price, which incorporates the price of rental equivalency value and all that sort of stuff. So even though this made-up basket of goods, which nobody actually spends on that in those weightings every month, is coming down, the actual cost for a lot of people is still going up, tempered with the fact we have utilities coming down. And wages, right? Even the trend is down, but wage growth is actually still fairly high. So I'll be interested to see how much this drops off. We've actually had a little, if I look at public sector has actually had a little tick up. That's going to worry. Private sector regular is, kind of the rate of decline has reduced a bit. And let's just go both of them in total. We can see this. Sorry, I'm trying to get rid of the regular one. We can obviously see this, the big spike up in the public sector one we had, which is their one-off payments. But we're still, both of them together about 6%, which is still high. So it's not like this is dropping off quickly, this wage growth, which is going to be something that will feed into those interest rate decisions. The last thing I wanted to talk about was, and this is now another, sort of contrarian factor, is unemployment. Just a caveat, I want to start, this is the latest unemployment release, okay, for April 24. It starts at the beginning of this, worth having a look at, talking about how unreliable this data is. I don't know if you remember, they've been using experimental data for labour force surveys. They've now been, reweighted it, brought back the traditional methodology, and we can see with that I just wanted to focus on the unemployment rather than all the rest of it. We are seeing, using the experimental data, we're seeing it coming down, 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 down. We've now switched back and it's gone up again. Okay, so how will that feed in to the Bank of England's decision? But caveat again, not a lot of liquidity in this data, therefore it could be massively skewed. So we've got a lot of push-pull factors, which has sent quite a few jitters through the market. However, there is discussion points about the Bank of England being the leading factor globally about triggering interest rates. Are they going to pull the trigger and go first? Because the state of the UK and the US are different, right? And actually, if we go and have a look at some of this data on this article I saw earlier, I don't know if you can see that, and if I can zoom in on it to make it a bit bigger, it's not actually zooming in the thing. Okay, so this is 2024 rate cut expectations. Now, if we look at where we were in December, this is when the market was going doolally and pricing in loads of interest rate cuts. If you remember, the 10-year gilt dropped down to about 3.4%, was it? It's obviously now back at 4, just above 4. We were expecting in the grey 150 basis points of 1.5%. That would have taken us down to 3.75 by the end of 2024. That's come down an awful lot to about 50 basis points, which is 0.5% down. But we are diverging from the States. The States is now, the market's pricing in 37 basis points, 0.37%, which is interesting that the UK is kind of diverging. So let's watch and see what happens with that over the next meeting or so. And feel free to put answers on a postcard when you think the next or the first interest rate cut will happen. And a lot of that is down to the inflation, the differences in inflation profile. Between the States and where we are now, you can see the States is definitely and dramatically leveled off, if not sort of ticking up, and you can see both Eurozone and UK coming down in a more desirable way. Now, that's not to say, okay, that we are here and we're going to start doing that stickiness. So all eyes are going to be on what happens to the inflation. Of course, this month's inflation release was declined less, or the rate of increase declined less than the analysts originally thought. But could it be that we pull the trigger first? So where do we think? I think it's inevitable that it's going to be longer than we thought before we get rate cuts. How will that affect things? The longer those rates are high, right, the more creaks there will be coming. I think the big losers right now, if I'm honest, are small and medium-sized businesses. let's not forget, and I'm really want to see over the next few months how these quite significant minimum wage increases filter into the system. We've talked about it quite a lot previously about, will it be inflationary, right, by putting these double-digit price wage rises in. What actually happens, when you look at economic theory, minimum wage going up by quite a lot, rather than being inflationary, actually puts a lot of pressure on small to medium businesses who can't actually absorb those costs, and so therefore have to let workforce go. Of course, if you let workforce go, you're not be growing, and it puts the whole thing into reverse and sort of damages the economy. So, with interest rates staying higher for longer, with that strong wage growth still happening, even though the trends are reversing, but we're now going to have maybe another secondary wave of wage growth with April's minimum wage changes. Is that going to put more pressure on businesses and really start to show some cracks in the system? Of course, if that happens and we see unemployment continue up, that's going to filter through to the property. So we're now seeing potentially higher mortgage rates, unemployment ticking up. Potentially that could increase with the things we've spoken about. So is there a sting in the tail? Let's not forget the geopolitical tensions, everything that's going on with Israel, Iran, and let's not forget the Red Sea, and let's not forget Russia, Ukraine. All of these things are still happening. Are we in a, sort of eye of the storm a little bit with that perception of confidence coming back in, with the sting in the tail that could manifest later in this year? Or are we just generally, through it all, and we will see, residential, sort of stagnate, as I think we're going to stagnate, or very small increases, I don't think in this year, but next year, as interest rates start to come down. That's what I've got today for you. That's a very, very quick overview of where we are. I'd love to hear your thoughts on it, team. I'm going to go through some of the comments. As I said, next week, I want to do a special on, again, I'm going to refresh commercial valuation methodology and look at commercial yield profiles in relation to recession, coming out of recession, and go, is this the right time to be getting back into things with the commercial valuation? I personally think it is, which is why I think there's a lot of opportunity. So anyway, Brody, hello. Yes, you think they are. Interest rates are going to go up. So you think they might not lower rates at all. Let me. I'm not going to put all of these. I know you put a few comments on, so I'll just read them out. May not lower rates at all. In fact, it's quite likely they raise them, and yet many people are convinced that rates are guaranteed to come down this year. Yeah, look, I agree, Brady. I think there is a perception. Remember, I make a point always about talking about the range of probabilities. So there's a myriad possibilities out there, and all of them have different probabilities. And one of the last lives I did a few weeks ago was talking about, actually, will the next interest rate rise be up? And there was an increasing sort of body of thought, certainly of the States, that's getting a higher probability. Maybe not as remote as people think it is. When you look at inflation coming down, but all that confidence coming back in, how does that feed back into the inflationary environment? It's an interesting one. So very much the same crowd who thought 2021 the Bitcoin was going to reach $1 million valuation imminently. Yeah. Well, that's certainly not happening at the moment, is it? The most intelligent way I've heard this put is that their main monetary policy tool is confusing the public. That's a good one. The Fed have been unambiguous about what their aims are in their internal documents. However, they've been extremely unclear in their public-facing communications, very much intentionally. Yeah, interesting thoughts, Brody. Thanks for that. Fastdale, hello, Fastdale. I'll put this on quickly. What are your thoughts on the validity of the 18-year property cycle? And would you expect a price dip in a couple of years relating to this? Look, I've got to be honest with you. I think we can't just go binary into this 18-year property cycle. You have to look at all the factors. I'm not saying we won't, but I think we're in the dip right now, right? And I haven't got the slides in front of me, but for me, and I've always said this, if you really care about property, you're a property investor, property entrepreneur. Even, dare I say it, if you're a property owner and not an investor, we have to be aware of the real value of property, which is inflation adjusted, because looking at an asset without its inflation adjusted, line is completely disregarding what it's actually worth. You could see nominal price rises in property, but real term value dropping. So it's the price of a loaf of worth a loaf of bread in 20 years time, for a property. So when you look at the real and inflation adjusted property graph, we have had a huge correction And actually, not just over the last 18 months. When you zoom out, we have really had a significant stagnation in real-time property. You look at a macro level, really since the financial crisis of 2008. In fact, let me just try and find it. So I don't know why I'm beeping in my phone. If I just try and find nationwide real house prices and try and find the graph, I just want to try and illustrate what I mean by this. Let's see what we've got. Here we go. This probably isn't the most up-to-date one, but it will suffice for the purposes of what I want to show you. Sorry, Fast Out. Let me just take your comment off so we can all see that. Okay. So when you look at this, graph, you can probably see that if we take it from post 2007 when we crashed, really take bracket there, right? We're actually below that in terms of real house prices, but on a macro level, it's kind of done nothing since the financial crisis of 2008. So that's now 15, 16 years, whereas a cycle in terms of real value, house prices have done very little. Which is why I believe that we shouldn't necessarily look at house prices as a store of wealth. I've always viewed investment property as a cash flow mechanism, and any increase in wealth is a cherry on top. The reason I say that, and a lot of people go, well, it doesn't matter if it's real or not. If it's going up, it's going up. I mean, in relation to other asset classes or other things, if you relate it to gold or things like that, if you just stick your money in property and hope that it's going to go up in value, there's probably better places you can put it if you're looking at inflation adjusted. Anyway, that's kind of a conversation for another day. But property does go in cycles. I think they're all different. Again, let's hammer that home. If we go here, not here, if we go to this one here, I always think this is fascinating. So I'm just going to go back to, I think this goes back to the 50s. When we look at UK house prices, let's just look at the overall, because then we can see the cycles. Okay, no, sorry, it starts 70s. Let's go 70s. So I could probably type that in without going quite so slow. So generally, right, you can see these little bumps along the way. These little bumps are cycles, right? So it's difficult to see. We'd have to zoom in on it. But we've got a peak there, then a dip down. So there to there is a cycle, right? We've got there to there as a cycle. We've now got here to potentially here as a cycle. So a lot of people I've seen on social media and forums, people going, look, in 2 years it's going to do its drop because that's just how the cycle works. Potentially validity in that. We'll have to see how it pans out. But I do think these cycles change because this graph doesn't give us a lot of good indication. If we go percentage change yearly, I think this gives us a much more interesting view of the cycles and how they work and how I believe that the cycles are actually compressing. So if you go back to the 70s, right, you see the rate of change. Okay, now this is, these are lined up. So on the nominal, you can't actually see a huge amount when you're zoomed in like this, but the rate of change was huge up and down, and then we've got another huge up, and down, and huge up and huge down. And these are proper percentage change yearly, and it's obviously charted every month. So it's a year-on-year change charted every month, right? We're up at, in the 70s there, we're up at 50%, in 1973. You come over to the end of the 70s, 30%. Right, then we go over to here to end of the 80s, on this sort of acceleration, 32%. And since then, right, we had, the biggest in the 2000s was 27.9%. Then we had the big correction of 2008. And when you actually look at what's happened since then, right, you look at the post-COVID boom, we've only actually had, what's that, sort of 12% is the highest year on year. There we go. That's June 2021, 12.3%. We've probably got a bigger one there. There we go. July 22, 13.7%. The point I'm making here is the cycles are compressing. So I don't think it's really appropriate just to say the same happens every 18 years. Maybe in trend wise, but I do think, a lot of things change. Again, if you look at it monthly change, we can see exactly the same. we can see these big spikes over here, but becoming, much less over here. So since 2010, we've obviously had this sort of big readout from COVID, where there's stamp duty things ending, all that sort of stuff, and it was a bit bizarre. But yeah, I think we can't just go cut and paste, cycle, and put a stopwatch to it. Is probably a long answer to that question. Sorry about that. Narrative. So let me put this on. Sharpie. Narrative of UK diverging with the US on rates is picking up steam. June will be crunch month. Yeah. I mean, it is picking up steam, isn't it? I just wonder. I wonder if there is steam, or if there is something to it. By the way, I'd be delighted for the UK to lead the road on this. I think I don't see the point in the rates being up anymore. We, as a country, we need to get back to some growth, right? I think what's going to be interesting is this election. We are obviously in election run-up to see what happens with that. Are people holding their breath? And what is the fallout when inevitably we see a change of government? I mean, I've just taken a calculated gamble. I've taken a finance facility out on a portfolio facility on a variable rate, because this was Lloyd's actually, and the fixed rate, the 2-year fix, was 0.5% below the variable rate. So as a betting man, I'd like to think that we will, within a year, on a 2-year fix, within a year, I'll be at that or below. And then, over the following year would pick up steam. So I think there's more, I think there's more potential for it going down and going up. So betting man, I've gone for a variable, because there's just not that much between the variable and the 2-year fix. There actually wasn't that much between the variable and the 5-year fix. I think the 5-year fix was less than a percentage below the 2-year. The variable, which probably indicates the banks are thinking that we're not going to go, when we do go down, how far down do we go? I was speaking to one of my clients about this yesterday. If the economy doesn't buckle, right, my thoughts are somewhere between 3.75 and 4.25 is where they'll end up. And as I've always said, where they end up is much more important on a persistent and long-term basis than where they peaked. Rob, I've missed you, brother. I've missed you too, man. I thought you'd stop making content. No, I haven't stopped making content. I've just been blimmin' busy, right? I said at the beginning, I do apologise. I've only got so much time in the day, and because I'm doing a lot of coaching out of hours. I forgot to say, I've written a book as well. So, I've written a 60,000 word book that will be published hopefully next month. So it's just been, and Easter holidays with the kids. I've got 2 kids, they're up north. So I'm up and down from Winchester to Chester quite a lot. And, I want to spend some time in Easter holidays with my boys. So sadly, the content creation is probably the first thing that has to drop off the diary over and above. Because there's been doing conversions, renovations, buying, training, writing books, all that sort of stuff. So I do apologise, but I want to get back into a more regular routine now. Certainly, I'm not out of the game. I know somebody posted that the other day. There we go. Anyway, let me know if you've got any questions, team. This was just a bit of a recap of where we are before we go into some more sort of in-depth looks at things. Next week, as I said, I'm going to look at the commercial world and say, is it actually commercial, residential, 2 completely different beasts in property right now? Everything we've talked about today is probably looking primarily at the residential market. Commercial, completely different kettle of fish. Really very exciting times for those who want to be into investing, but in the commercial market. And again, when I say commercial, I don't just mean retail flats, retail offices. I mean anything with a commercial valuation on it. So we'll talk about that next week. All right, team. Unless you've got any more questions, I will call it a day for today. Time to go make some dinner. It's great to be back. Don't forget, if you got some value, or if you get some value from these data-driven conversations, these sort of fireside chats, if you like, please subscribe to the channel. It gives me a load of kudos with YouTube, and that will give more reach to put it in front of the right people as we get back to growth on the channel. We hit 4,000 as I wasn't projecting, so let's get it to 5,000. Team, let's do that together. All right, I'll see you next week. Have a great one.